Hi, everybody. This is Samantha from the Law Offices of Samantha Wolfe. Happy New Year. We're starting off 2025 with our monthly virtual seminar, and today I'm excited because we're going to talk about charitable gifting. So I'm going to go ahead and share my screen here so we can start our presentation. Just as a little background, we do always upload our videos to YouTube, and we do this just because we feel like it's important for our clients to be able to have access to information. We feel like it falls into our mission statement, so we're happy to always try to put new content up on our social media sites. So like I said, today we're going to talk about charitable giving. So I wanted to start off about charitable giving talking about an asset list. The reason why I think this is important is that a list of accounts, assets, how they're titled, where they're located, the account number, the approximate value, any beneficiary designations, financial advisor's name, contact information, an attorney list, and an accountant information. All of these are important. We ask for this information as part of our asset intake sheet that we always give to initial consultation clients. We do this because any asset where you have designated a beneficiary, that does not go through your will. And so it's important for us to know when we're talking about charitable planning, what assets do you have in what amount, so that if you wanted to provide for certain charities, we could do that. We might even be able to do that using a charitable beneficiary, and we'll talk about what the benefits are of doing that versus having it go through the will. So just so if your attorney asks for the account information and where assets are titled, just so that we know when we're talking about charitable planning where we should take the assets from. So let's start with to designate or not designate. And when we're talking about this, we're talking about, do we put a charitable bequest in the will, or do we designate a charity on a beneficiary designation through assets? And to designate or not to designate, there might be some tax reasons that you might want to do it. And there also might be some reasons to do it as far as if you have a specific purpose that you might want the funds to be used for. So for example, for tax reasons, it might be beneficial if you're already charitably minded and want charities to be able to benefit from your estate to designate those charities on your beneficiary designation. And the reason for that is because there are certain assets, retirement assets, for example, are subject to inheritance tax when you die, if you're a resident of Pennsylvania, and they're going to be subject to income tax for your beneficiaries as it's drawn down. So for example, if you have an IRA and you're the beneficiary of it and you're taking required minimum distributions, as you pull that RMD out, it will be subject to income tax. So retirement accounts are subject to two taxes, inheritance tax and income tax. So if we designate a charity as a beneficiary, then what we're doing is we're taking retirement assets that would be subject to both income tax and inheritance tax, and we're making it so that they're only subject to one or none of the taxes depending on the designation. So for example, if you have a retirement asset and you want the entire retirement account to go to charity, then it's not going to be subject to inheritance tax, and it's not going to be subject to income tax if it meets the charitable donations requirement. Now, the one problem with designating charities as a beneficiary on your retirement accounts is that it's very difficult to allocate those funds for something specific inside the charity. So we have some clients that might want to designate, for example, a church, and they want it to be used for specific funds. Like, for example, sometimes it's for a new building fund, sometimes it's for missions. So if you want to allocate it for something specific inside that charity, beneficiary designations typically do not allow you to be able to designate a specific purpose for those charitable funds. In your will, though, you can actually earmark it for whatever specific allocation you want. So if you want it to go to missions, you can do that. If you want it to go to the building fund, you can do that. You can also do it for general charitable purposes. So go ahead and advance the slide. Let's talk a little bit about this. So retirement, we talked about this, is subject to inheritance and income taxes. So it's just making sure when we're looking at charities, should we have it be a retirement designation? Now remember, if you're somebody who's saying, I want so much of my estate to go to charity, so a popular amount is 10%. If we have clients that want 10% of their estate to go to charity, and they're going to choose to fulfill that using a retirement beneficiary designation, then it might actually be a higher percentage of that retirement. Because if we have a client whose entire estate is worth 1 million and their retirement is worth 200,000, if they want 10% of their entire estate, of the entire 1 million to go to charity, it might be a higher percentage of the retirement if that's what we're trying to do. So just know that if you're meeting with an attorney and they're saying, well, we might want to do 50% to charity of their retirement, it might be so that you can fulfill your overall percentage of the entire estate. The benefit of it passing through through beneficiary designations is it passes outside of probate. So probate's the process by which your executor gets appointed and then distributes your assets according to what's in your will. And if you have a beneficiary designation, remember that doesn't go through probate. So it doesn't go through the will provisions. It's a lot less complicated. The beneficiaries get their funds quicker. So that can be a pro for designating the charities as a beneficiary on their retirement account. One concern that you should be aware of is liquidity concerns if assets pass through the will. So for example, most of our clients have real estate. It might be their house, it might be additional assets. And so typically you can't do a beneficiary designation on a deed. You can either add somebody to the title or you can transfer the deed into a trust to avoid probate, but you can't do a beneficiary designation. Excuse me. So if you have real estate that's passing through your will and you're going to have things like real estate taxes, expenses, and insurance that you have to pay, just know that if you designate on a retirement account, are you going to have enough funds to pay those taxes, insurance, and expenses on the real estate? So that would be one reason why you wouldn't want to designate charities as a beneficiary on your retirement accounts, because that might be the way that you're going to have liquidity to pay those certain expenses. Now, allocation to a specific purpose, we already talked about that. That's very difficult to do through a beneficiary designation, but you can do it through the will. So if you have some specific reason or purpose that you want those funds to be used for, then typically you're going to use your will or a trust to do that. Now, the benefit of designating beneficiaries is if you decide to change your charities, if you change your percentages, any of that, it doesn't require the execution of a new will. So that's a positive. Now, sometimes what I'll do is I'll do a little bit of a hybrid. So if we have a client that says, I'm going to designate charities as the beneficiary of my retirement, but maybe they're concerned that they won't have enough retirement, or they want to make sure that there's some benefit of it going through the will, I might draft a will that says, to the extent not satisfied through a beneficiary designation, then the charity receives X amount under the will. That way we have our bases covered there. Now, charitable planning is a way to support charities and nonprofits that might be near and dear to your heart, and it can be expressed typically through your estate plan, so your will. You can give gifts while you're living. You can have a bequest in your will or in your trust as well. Now, the tax benefits would be when you donate to charity, there are specific taxes that you're able to avoid. So we always want to look at inheritance taxes. So inheritance tax people and you're a resident of Pennsylvania, then there's going to be inheritance tax unless it does go to charity, and then charities are not subject to inheritance tax, so it avoids the inheritance tax. However, if you would say, well, I don't want to wait until I die to make these charitable transfers, I want to do it while I'm living, then there might be some income tax benefits to you to be able to do that, because there is a public policy that is trying to get people to make charitable donations, and so there is some tax incentive to making some charitable donations while you're living. Let's talk about the charitable remainder trust. So, a charitable remainder trust, we call this, sometimes we'll call it a CRUT or a CRAT. Those are just the acronyms that we use to describe it. So, a charitable remainder trust is a type of irrevocable trust. And the thought here is that because the word remainder is in the title, it means that charities get it upon some event. Usually it's a death of a beneficiary. So, if you set up a charitable remainder trust, you might say, during my lifetime, I want to receive so much every year. So you might say, I want to receive 5% out of the trust every year. And then at your death, the remaining amount in the trust might go to charities. So that would be one example. Another example is that you can do it where you have other beneficiaries. So it could be you set it up for the lifetime of your children where they receive 5% out every year, and then at their death it goes to charities. That would be another way to use a remainder trust. The important thing to know about a remainder trust, though, is that charities get it at the end. We're going to talk about a charitable lead trust next, and that's where the charity gets the benefit up front, and then once a certain term of years or a certain monetary amount pays out, then it goes to the residuary beneficiaries who are individuals. So that's the difference between a charitable lead and a charitable remainder trust. The tax incentives of a charitable remainder trust would be that it allows the trust settlor or the grantor or the person who's setting up the trust to take a federal income tax deduction whenever the trust is funded. And then the investment income that's generated is also tax exempt as it's earned. And so that helps keep more assets in the trust earning income, which can have a tax benefit as well. So when you're talking about charitable remainder trusts, number one, it can help you plan major donations to charities that you support and allows you to get the income tax deduction now, not when you die, but now. Number two, it provides a predictable income stream for life or over a specific period. So you might say for a 10-year period, I want to receive 5% out of the trust, and then after that 10 years, it goes to charity. That would be another way to set it up. Number three, it allows you to defer income taxes on the sale of assets transferred to the trust. So sometimes we have clients that might have real estate that has a lot of capital gains that would be recognized when the real estate would be sold. If they convey it into a charitable trust, they don't actually have to pay capital gains if it's structured correctly. So that might be another reason that people would use a charitable trust. And then number four, it may allow you a partial deduction based on the value of the charitable interest in the trust. We have all kinds of cool programs that allow us to run figures saying, well, if I fund my trust with X amount and I get 5% out every year, what type of charitable deduction can I get? And sometimes clients will use this in conjunction with other planning techniques. So sometimes we'll use it in conjunction with a Roth conversion where we're taking a traditional IRA and we're converting it to a Roth IRA, and we know that's going to generate some tax, and so we do a charitable trust or we do a charitable donation that would offset that income tax from the conversion from a traditional IRA to a Roth IRA. Now, the second type of charitable trust is a charitable lead trust. This is where it goes to the charity first. It is still a type of irrevocable trust, but usually it pays to the charity at the beginning. So for example, you may say for a 10-year period, the charity is going to receive 5%. Once that 10-year period is over, then it's going to pay to my individual beneficiaries, or it's going to pay back to me. However you want it to be, the charity gets paid first. And typically, a charitable lead trust is going to give you a higher income tax deduction because it's going to the charity at the beginning, the offset. However, it all depends on how much or the percentage is paying to charity. That's going to determine what your charitable deduction is. So this is a diagram of showing how a charitable lead trust works. So we have the donor, and number one, the donor contributes cash or other assets to fund the trust. We have a charitable lead trust that's listed there. And then number two, the trust makes payments to the charity on a fixed schedule for the term of the trust. And then number three is saying the remaining assets in the trust pass to the donor or to another designated beneficiary term expires. Now, the little tip on this diagram is saying a charity with a donor advised fund program can receive the payments from a charitable lead trust. Now, this is important because we're going to talk about qualified charitable distributions in a minute, and it's important to know that you can't use your QCDs, your qualified charitable distributions, and pay it to a donor advised fund. It does have to be to a charity. But for a charitable lead trust, you can still have it pay to a donor advised fund. That just means that it gives you the flexibility to not say what charity it is, gives you the ability to decide as time goes on. Let's talk about charitable gift annuities. So where charitable lead trust and charitable remainder trusts are a irrevocable trust that we draft here at our office and help you fund, a charitable gift annuity is a contract between you and the charity where you're making a gift to the charity and in return you're receiving a fixed income for life. So it combines charitable giving with income generation. Now the difference here is that we typically aren't going to do anything related to that. We don't have to draft anything. We don't have to have any legal documents in place because a lot of charities or financial institutions already have the charitable gift annuity contract ready to go. So in this case, number one, we have the donor. The donor signs an annuity agreement with the charity, making a lump sum distribution or donation, and then takes a partial tax deduction, goes to the charity. And then number two, the donation is invested by the charity. Number three, the donor receives payments on a fixed schedule for life per the terms of the annuity agreement. And then number four, the charity receives the balance of the invested funds upon the donor's death. So it's more like a charitable remainder trust. The difference is that we don't actually have to draft anything legally. So now the charitable gift annuity, it has a fixed income which provides that predictable income stream for life. Tax benefits, it's a possible charitable deduction and favorable capital gains treatment. And then it does leave a lasting legacy impact on the charity of your choice. For the charities, the reason they want to do it is that it provides immediate and future financial support for that charity. The pros and cons of a charitable gift annuity. So the tax implications, so the pros would be this: federal and state tax benefits, including an income tax deduction. Your tax deduction is usually 25 to 55% of the amount you transferred to charity. So an example would be if you created $100,000 gift annuity at age 70, you would expect to receive $4,700 in payments each year. So that's that stream of income that's coming back. Now, the cons of that would be it's irrevocable. So once you transfer your money, you can't get it back other than that, in this example, the $4,700 you get annually. Now, as opposed to standard annuities, which may allow you to terminate the contract for a lump sum, there might be some fees and other charges, but you still can actually get out of the annuity. With a charitable gift annuity, you can't get out of it. Now, another negative would be it's a one-time opportunity for those funds directed from an IRA. So you can fund more than one charitable gift annuity, but they all must be completed in the same tax year, and they collectively cannot exceed a total of $53,000. And then lastly, they're only as safe as the charity is sound. So if the organization goes out of business, goes belly up, your payments will disappear with no way for you to have any recourse against that, other than to get in line with everyone else that's waiting for the charity's remaining assets. Now, how to set up a charitable gift annuity would be you'd meet with your financial advisor or your estate planner. What we would do is we would make the connection for you for the charity that you want to benefit, and then draft and sign a charitable gift annuity agreement. And like I said, normally our office does not have to do that because charities typically have like a boilerplate agreement that they would use. Now, if we'd be in a situation where we'd need an agreement, then our office could draft it. And then you're going to transfer assets to that charity under that agreement and that contract. And then the income, you start receiving the payments annually. Now you need to consider your age and your income needs, because if you're only going to get $4,700 in our example, you need to make sure that you're going to have income coming other places. You want to make sure the selection of assets to fund the annuity would be proper and an efficient use of those assets. And then you want to make sure that this meets your charitable goals. So let's move a little bit and let's talk about qualified charitable distributions. And that should say QCD, not QVD. They're actually right next to each other on the keyboard. So I think I just mistyped. In 2023, people who are age 70 and a half and older may elect as part of their qualified charitable distribution limit a one-time gift up to $105,000. Now it is adjusted annually for inflation to a charitable remainder trust. That's the CRUT and the CRAT, or a charitable gift annuity, and that's an expansion of the type of charity that can receive a QCD. You still can't do it to a donor advised fund or to a private foundation. And Secure 2.0 did index that 100,000 for inflation beginning in 2023. So in 2025, individuals 70 and a half may use their qualified charitable donation to donate up to 108,000 to qualified charities directly from the IRA. That's an increase of 3,000 from 2024 when it was 105,000. Now know that because this is going directly from the IRA to the charity, it doesn't get included in your adjusted gross income. So this is different from the charitable deductions we're going to talk about in a couple of slides, where you have to itemize, and you're only going to be able to take the charitable donation if you can itemize your deductions. In this case, it's never coming into your adjusted gross income. It's going directly from your IRA to the charity, and because of that, you don't have to claim it for income tax purposes. And that's the beauty of these qualified charitable distributions, and that's why we like them so much, because if you have, for example, would have an RMD, you can just take that RMD up to 108,000 in 2025 and just have it go directly to the charity. Now, charitable deductions, as we're closing out 2024, as we were closing out 2024, still must be itemized. So you can't take charitable deductions unless you are itemizing. Most of our clients use the standard deduction, so they're not actually able to itemize their deductions. But if you are able to itemize, you can take charitable deductions. There is a ceiling, which means that 60% of your adjusted gross income ceiling on charitable cash contributions. That means that you can't deduct more than 60% of your adjusted gross income. Now, the limit for appreciated assets in 2024, that would be stock, for example, is 30% of your adjusted gross income. So 60% is the maximum. That's going to be on cash contributions. If you're doing things like stock, then it's 30% of your adjusted gross income. Contributions to certain private foundations, that's what that PF means. So certain private foundations is also going to have that limit of 30%. So the important thought of this is that total deductions are capped between 20 and 50% of a taxpayer's adjusted gross income for non-cash gifts to non-qualifying organizations, meaning a private foundation. It's not a public charity. And that's based on whether you're an individual who's doing it, a business, or a corporate donor. If you're able to do a cash contribution, then again, you get the 60%. But if you're doing something other than cash, you're somewhere between 20 and 50% of your adjusted gross income of what you can deduct, and that just depends on what your role is, if you're an individual business or a corporate donor. Now, there are some opportunities related to IRAs, 401ks, 403bs, or other qualified plans. So you have to take an RMD from your IRA before the end of the tax year, which means that you do have to pay income taxes on that income. You can avoid taxes on an RMD and the charity by donating your RMD instead, and that's where we talked about that qualified charitable distribution. So that would be, it's also known as an IRA charitable rollover. It allows you to make a gift that's tax-free. The maximum amount is $108,000 for 2025 directly from your IRA, and it does satisfy your RMD. Difference here is, again, we don't have to ever include it in our adjusted gross income. Like we talked about beginning in 2023, that is adjusted for inflation. You also can give a one-time charitable gift annuity up to $50,000 from your IRA, and that will then allow you to receive the guaranteed income for life. For 2025, this amount, because it is adjusted for inflation, is $54,000. So charitable limits, the couple of things you need to ask is, does the taxpayer itemize deductions? So in 2025, that would be the standard deduction in 2025 is 15,000 for a single individual, 30,000 married jointly, 22,500 for heads of households. Anyone over 65, it's 17,000 for a single or for a head of household, or 33,200, which is 1,600 per qualifying spouse, married filing jointly with both spouses 65 or older. If you're not going to be able to itemize, then you can't take charitable deductions. Now, you can do that qualified charitable distribution that we just talked about for your RMD, but you're not going to be able to itemize any deductions, or you're not going to be able to take any charitable deductions on top of that, I should say, because you're not itemizing. Cash contributions up to 60% of your adjusted gross income if it's to a public charity. Non-cash contributions is that 20 to 50% of the taxpayer's adjusted gross income, as long as it's to a qualifying organization. So 50% to public charities and then 30% to a private foundation. So I have it listed here, up to 50% for non-cash property contributions, up to 30% for investments that appreciated, up to 20% for gifts of capital gain property to a private foundation. And you can also carry over deductions up to 5 years if they're charitable. So here's a little chart talking about cash versus appreciated assets and the public charity to a private foundation. So weirdly, they call private foundations a non-qualifying organization. That just means it's not a public charity. So that's why we break it down that way. So again, 60% appreciated securities is 30% if it's to a public charity. If it's to a private foundation, it's 30% for cash contributions or 20% for appreciated securities.